Hello and welcome everyone to today's session. My name is Mohammed Shanti and I will be your host for today. I'm a market analyst at FXBiz and AGM Securities, and today's session will be covering the US market open. So a lot of things that happened today in today's session, and as you know, all the inflation numbers came also from the inflation numbers from the UK. Also, we have some extra news coming. Also, we saw a lot of huge movement in the US dollar and also gold, oil, all other markets in general. Before we continue, let's talk about the risk disclaimer and all the information that we provide here in our channel and even in our weekly or daily videos. They are all for insightful information, all for educational purposes and to help you with your trades. We don't give recommendation and we certainly don't provide investment decisions for you. So basically use this channel or these videos for you to help and to understand how the markets are going. And basically things should be, if you continue to stay with us, you will definitely have a lot of information. And at the end of this session, I will give you a gift for especially for short-term traders, a trading indicator that might actually help you out with exiting your trades rather than entering your trades. Let's say if you have a winning trade and you're not sure 100% when to exit the market, I will be giving you this indicator at the end of the session. But let's start with what happened in this market. So what happened in the market today? Basically, the most important event that happened was the US CPI. The US CPI surpasses forecast, rising to 8.5. The annual inflation rate in the US increased to 8.5 in March. It's the highest rate increase since December of 1981, up from 7.9% in February. We saw a lot of movement in gold. We saw a movement on the US dollar, and as you all know, that sometimes the market move extensively just exactly at the moment of the event. So if you noticed, the interest rates in the United States, they are continuing to rise. If you look at the 10-year bond yields, they traded near a fresh cycle of highs near the 2.83%, and it's currently in course to head the October 2018 highs of the 3.26, which this has actually sent the dollar index beyond the 100 mark. And this happened for the first time in over 2 years. But after the CPI data, the dollar returned near its opening level. So if you look at the US dollar, any pair against the US dollar, you would see a huge candle to the downside, especially if it's if it was euro against dollar, you would see a huge candle to the upside. While if you look at the dollar yen, it went below the 6-year half highs of almost 125. I'm gonna show this to you at the trading platform now on the MPD4. So this kind of inflation rate in the US increase actually it's kind of are constant to the what market expectation are looking for. So even though it came a little bit higher above the 8.4%, yet the consumer prices increased by 1.2 on a monthly basis. So the largest increase since September 2005, which is mainly in line with the projections. Now, higher inflation rates means higher expectations of the Fed pushing their interest rates higher by 50 basis points or even more. So this actually could boost the safe havens in general, right? Because people are afraid of inflation when they trade, and in order to hedge their inflationary tool, in order to hedge against inflation, what they do, they seek out inflationary hedging tools such as gold and US dollar. But what we saw today, a sharp drop. I don't want to say a sharp drop, but rather a turning down for the US dollar, which actually gave some live action on for the euro dollar pair, the yen pair, dollar yen pair, and also gold. And even we have all news coming from oil, and you could tell oil prices are actually recovering. Going for the UK unemployment rate, actually also falls to fresh lows since the end of 2019. So the rate of unemployment declined to 3.8% in 3 months, leading to up to February, mirroring the percentage recorded during the last 3 months of 2019. So the unemployment rate in the United Kingdom fell further below the level seen immediately before the coronavirus outbreak, emphasizing the danger of inflationary pressure in the labor market. Now, this has actually prompted the Bank of England to issue some kind of alerts. So since the rate of unemployment declined to 3.8%, it's kind of mirroring what happened in 2009. So there were some signals of a slowing demand from workers, which coincided with the larger concerns that rising inflation may cause the economy to stall this year as salaries fail to keep the pace with inflation. This actually put some kind of pressure on the pound, but we're seeing after the US inflation rate reading, we saw something else. I'm going to show you the pound against the dollar and how we can trade it in today's session. Going to another important thing happened was the oil prices. Oil prices actually saw some kind of drop yesterday, almost 4%. And today recovered that. So WTI, the Western Texas Intermediate Oil Crude Futures, rose almost 4% today, recovering from 4.5 loss the previous session, as the easing of the lockdowns in China especially improved the demand outlook. So despite the fact that some virus restrictions have been removed in China, most people are still quarantined, but still that pushed the oil prices to higher today. And also, if you look at it from another point of view, is that OPEC also cautioned that if the EU were to prohibit Russian oil, it would be particularly difficult to replace the lost supply. Okay, so even though there was no agreement to prohibit the Russian petroleum, the EU is allegedly formulating plans for an oil embargo on Russia. So there is some kind of tight supply, and a little bit some shake off in demand. That's why we are seeing some price pullback to the upside in oil prices. Later on Wednesday, we have the RBNZ, the Central Bank of New Zealand, the Reserve Bank of New Zealand. It's expected to raise interest rates on Wednesday, although economists are divided on whether the increase would be whether it's going to be 25 basis point or even 50 basis point. So assuming if they did or push it to 25 basis point, so the Kiwi, the New Zealand against the US dollar, the Kiwi might decline against the greenback. So following the high NAB business optimism numbers for March, some traders would be could be betting for that the RBA would surprise the market by raising interest rates in May, even in May rather than June. So keep tabs on that on Wednesday. So there could be a potential trading opportunity over there. Either way, use this kind of information to consume what's going on in the market and check it up in your charts. So let's go to the charts real quick. So we have here starting with the precious metal gold. And as you can see, the prices actually are hovering above the moving averages. The indicators are pointing to the upside. Everything seems kind of bullish, but if we look even closer, there are some tricky moves could happen in this market. So starting with the 1972 mark, which is an important high that must be defeated in order to see continuation to the upside. But what should we do next? So many traders could actually could have taken trade from this area and aimed to the 1972. Where should we aim for bullish traders? What's next? So the main level is the 1972. So all indicators are pointing to the upside, especially the RSI almost reached the overbought territory, but never reached that area. So it went down again and kind of pointing to the upside now. So prices could reach the $10 difference over here. So there could be a trade over here for bullish traders now, but with some cautious degree of risk. So because you're basically in the middle of the if there's going to be a high trend or a continuation trend, basically you're at the middle of the road. Okay, so you're not taking a trade from this area, you're taking the trade from here. So if you took a trade from here, that means you're almost half of the way of the full trend. So basically you need to have a lower risk compared when you took a trade from this area, because the moving averages over here are kind of, if you took a trade from this area, the moving averages would be your safe haven or your place to know where exactly your stop loss could be. Now your stop loss, if I'm a buying trader, I would put it definitely somewhere around this area, which is near the 1930. So that's a quite different $30 mark. So my target could be the double, which is almost 2000 mark. Which is it valid or let's say setup for us? No, this is a really huge. So what you can do is that you can put a stop loss below this support line over here, which is the 1948. All right, 1949, 1948. This line is very crucial. This line was at actually a resistance level. This line almost got defeated 3 times, but it never happened. It only only happened just a day or 2 days ago. And as you can see, prices defeated this level, pushed up, and then went back again. So it's basically we saw some retesting over here, but prices continued to the upside. Therefore, our main, let's say for buyers, our main stop loss should be below this level, 1948, 1949, because once you saw prices go down, you could see prices continue in this narrow range. So the narrow range is between these levels, basically the 1916 and the 1949. This is a huge, let's say, horizontal channel. And if you took a trade from a buying position here, you need to have a stop loss here. But if you saw prices defeat this level again, expect the trend, or let's say the range, happening again between these levels, between the 1948 and the 1916. You could see prices continue go back and trade within a narrow range. Now, what happens if prices defeat the 1972? Expect the 2000 mark. So the next level after the 1972 is the 2000 mark. If you look at it from this side, okay, you can see we are at very important, very important resistance level here, over here, this area. So this area over here almost 3 times retraced from it. So after defeating the 1972, the next level will be near the 2000 mark, which is 2007. So let's put a mark over here so you can see it clearly. So here, this area is the next level after the 1972. So here also, there was a high over here, almost immediately retraced back from it. And now we're seeing prices actually testing this level. So this bullish uptrend after this narrow range happened, we need to have more confirmation. Now, the RSI, the MACD, both of them are pointing to the upside, meaning bulls are in control. Yet this could change near this area. So today prices actually touched the 1972 after the CPI numbers, but now we're seeing prices retraced a little back. So we saw some wick. Now the hourly candle, the 4-hour candle, actually, it's pointing to the upside. We need more confirmation. The confirmation is this, a defeat, and the close above this level would give us a more clarification where this trend could go, which is the 2007. Now, if prices went below the 1949, the main level to watch for would be the moving average over here. This level over here, near the nearest simple moving average of 100, which is the 1933. So I would rather take, if let's say prices went below this trend line and saw a breakdown, prices must go all the way to the 1933, and from there I might get out. If I took a sell trade from here, I might get out here, because you cannot tell where this range could end. So basically, I wouldn't risk it to here. I would risk it to the 1933 mark and wait for more confirmation, because you could see prices go up, down, even a test of this trend line, and then continuation. So be careful with the precious metal in particular. Going for oil market, if you look at the oil market, it's quite in the past actually, if you look, this is the 4-hour chart. So in the past let's say days, we saw past 3 days, we saw the oil market went down and down and down, up a red market basically. But today we saw prices recover the 4% loss that happened in the past 2 days, right? And almost recovering. So this was 4.5%. Now it's almost 4%. So it recovered the losses happened in this day. So what do we do next? What's the aim here? Now the 100 mark is the main level to watch for. So let's put a mark over here. The first mark is the 100, which is a psychological mark. Okay, a lot of traders are afraid of this 100. All right, usually they tend to wait for any action happening in this area. What's next? Even though if we saw this got breached, the main thing to watch for is the moving average, 103.40. A defeat of this level, we could see prices all the way next to the 108 near this area, or 107, and then next to the recent highs of 115. Now, the 115 is the main level in the long term. A defeat of this level, we could see prices all the way back to the 120. Let's go a little bit to, let's say, a more frequent used chart, which is the hourly chart. Now, you can see the RSI is pointing to the upside, and we are seeing actually some trend happening here. And we're seeing here the MACD. There is a bulls controlling the market. We saw a breakdown, or actually, sorry, a breach to the upside. This breach could be tested in the next hour. So we could see prices retrace back a little bit and test this trend line again, or we could see a continuation to the upside near the moving average, which is almost the 100 mark. So the 100 mark is the most important level that I need to watch for. So the 100 mark, we could see a really huge bullish candle to the upside in the coming hours, or we could see a small retracement happening to this area. So how can I tell if this is gonna continue or not? This is the main level to watch for the bears. So if, let's say, the prices went back and defeated the 96.50, that means we could see a continuation to the downside, and then the next level to watch for is the 93 or the 92.80. All right, even though we have confirmations, the MACD is actually making a low, a higher low, a high, maybe another high. So high and then another low, higher low. We could see retracement from the MACD and then continuation. What do? Wait for a crossover above the zero line. We need to see these two cross to the downside and then cross back up. A cross back up, that means continuation to the upside. This could be my signal to enter. So be patient with oil. Always use the proper lot size in your trading. Okay. Now let's go for another market, which is the euro dollar. Now, a lot of things happening in the euro dollar. Now, I know there are so many highs over here, so many points to point out. But if you look over here, let's add some shapes so you can see this area over here is a range happening. Yeah, we saw prices tend to trade between these two lines, basically. The first one here and the second one is here. So as the dollar got weaker a little bit in the session, I know you couldn't see it here. So basically this green candle over here, that's because of the inflation numbers. This inflation numbers pushed prices all the way almost 30 pips or even more, 40 pips higher. Now it went back again. So we're a little bit confused. The markets are a little bit confused in that regard. So we need to wait. We need to wait for more confirmation. Now we can trade the narrow range trading, basically buy from this area, which is the 1.0850, but I wouldn't aim for the 1.1 spot 0936. I would aim somewhere lower, somewhere over here. So it's basically 20 pips. So 20 pips up, and then once it's reached this area, 20 pips down. You can trade this way for the euro dollar. However, I'm more biased to the downside. Why is that? Because first of all, we have, if you look at the RSI, basically it's near the 50 mark, but still we're not seeing any let's say any kind of oversold territory happening. And also there is many highs happening. If you look at the RSI, there are many levels, or we could say this is a support resistance level happening. And since this mark is not defeated over here, I could expect prices to continue down near the oversold. Now this range is confirmed by the RSI, as you can see, near the 50 mark, while the MACD is pointing to the downside, but still near the 0 mark. So as long as prices are continue this kind of movement, this price action, could expect the narrow range happening. What do I do if prices defeated the one spot or 850? So I would rather wait for a price to go down and then a pullback to the upside and a retest. Once this retest happens, all right, if prices continued back again, that means narrow range trading. If prices went back down, that could be continuation. How do I confirm continuation? Use the MACD. The MACD over here, we could see a bullish crossover and the next bearish crossover, something like this. So over here, if you look at this crossover over here, at this candle exactly, it gave us bearish signal and it gave me almost 40 pips. This is what we were looking for a continuation trade. Okay, that's from the downside. Now let's go to the top side. From the top side, we have this level, the moving average. Which moving average? The 200. One spot 0972. We need prices to go above this level to confirm the end of this downtrend. This downtrend over here that happened. We need the prices to go above it to confirm an end to this bearish setup that happened. So as long as prices are not going above this level, that means I'm more bearish than bullish. So keep this level on always in your mark. Okay. Going for the Dow Jones. I know a lot of traders love to trade indices and even the stocks market in general. So let's have a look at the Dow Jones index. So the Dow Jones index, and as you can see, there is a huge movement, a huge volatility. First of all, we saw a huge down and then a huge bullish setup happening. So this kind of setup, this kind of technical picture is kind of tricky. It really depends on what to trade, on how the US dollar is faring, how the markets are faring. So there is some kind of cautious trading happening from traders and so on. This is why if I'm not sure about my indices, I need to have a different view. Where do I go? I look at the VIX roll index, the VIX index. The VIX index is something like this. So the VIX is currently going down, yeah? In general, there is a bearish downtrend happening, but we are seeing here a double top formation. That means as long as this VIX doesn't go above, that means the Dow Jones could mean continuation to the upside, a continuation to the upside. That's why we need this trend line to be defeated from the top side. Now, the first mark needs to be defeated as this, which is the, so we need this mark to be defeated, which is the 34,774. A defeat of this level, that means the next high, which is the 34,907, and the next 35,100 mark. So these levels are important. We are seeing a bearish channel happening. We could see prices continue up and then down. That's why it's kind of tricky. This area is very tricky to trade from because you're in the middle of the road. So what do you need? You need to see either a drop to the 34,120 or even more and take a trade from this area. Check the VIX index. If the VIX index is going up, that means huge chance that the Dow Jones is going down. Or what we can do is once prices reach this area, I can make a trade to the upside and aim for the 34,774. If we saw this trend line tested and then went down, that means this bearish channel continuation. So if you look at it from this way, you could tell that there is a bearish setup happening. All right, but once prices defeat the the 34,800 mark, wait for more confirmation, a retest for this bearish trend line, or a continuation above the 34,900. If this got defeated, aim for the 35,000 mark and even more. Lastly, I want to show you the trading indicator that I've told you about. All right. So a lot of you traders love to trade and enter a really good setup, but the problem with your trade is that I might have a certain take profit level, but the thing is, sometimes my take profit level is very close and I might re-enter the market again, or I don't like the take profit level, let's say, and I want to know when to exit at the best time, because it's kind of, I don't want to say it's impossible to find out the best highs to exit a buy signal or a previous buy that I've made, or to exit at the exact low. So what do I do when this kind of what can I do when I want to exit and trade a really perfect trade? So let me show you at a different chart over here. So if you look at this chart over here, we have the precious metal. Okay, so let's go for the 5-minute chart. I know a lot of traders love the trading charts. So assuming that you've entered somewhere around this area, when should I get out? Should I wait for my take profit levels to be hit, or should I wait for a pullback happened and then continuation? What should I do? Add this indicator. It's called the relative vigor index. It's a very simple indicator, relative vigor index. It's a double cross indicator. That means there is two lines crossing each other. Whenever they cross each other, that could be a signal. However, I don't use it to enter the market. I'd rather use it to exit a market. We don't use the default settings here. I use the 20 period, all right, and I use it this way. So assuming that I've entered based on my technical analysis over here, using these charts over here, using the MACD or even the RSI or even the moving averages or the price action by itself, all right, going to the 5-minute charts, I would rather go different chart to decide when to exit. So the moment this indicator, let's say I've entered this area or even this area, the moment this indicator stays above the zero line, can you see the zero line over here? The moment it crosses below each other, once the red line cross above the green line, this candle exactly, if you look over here, exactly at this candle, that means that is my exit. If I exit here, I wouldn't see this kind of loss happening. I wouldn't use it to enter the market. I would rather use it to exit a market. Always use technical indicators, use pivot tables, use Fibonacci, use whatever you have in your system. However, always use an exit indicator to tell you when to get out. Sometimes you don't have to get out from here. What you need to do is use it as, let's say, an alert for you. Use it as an alert whenever this cross, if you have a bullish trade and the ROI is above the zero line, wait for a bearish crossover. So this bearish crossover over here told me that there could be a retracement happening. I could get out over here. Now, let's look at the previous trades. All right, let's assume that you took a bearish trade from this area. Okay, now the moment it cross above, once they cross above each other, that's my exit. So this trade happened here all the way down. If you look over here, it never crossed back again all the way until this candle. Exactly at this candle, if I took a trade from here, I've exited almost near the lows happened. All right, so I would rather exit here with certainty rather than trading and almost in a FOMO trade, and then I might lose whatever wins that I've made. That if you're not using multiple take profit levels. If you're using take profit levels, what you can do is sometimes you might lose all the cake, let's say, because this kind of, once you use 1-to-2 ratio of stop loss, one stop loss against 2 take profit levels, that means there could be a chance that I might miss the big trend. Trend traders are the biggest winners over here. So it actually demolishes the winners of the reverse traders. Basically, use this indicator to tell when to exit your trade. Whenever the prices are above the zero line, look for a bearish setup, bearish signal, which is whenever the red cross the green. And whenever prices are going down, look at the indicator whenever they cross each other above. That means an exit. It's very simple trading indicator. Anyways, thank you so much for your time. Thank you so much for hearing me out. I know a lot of you want more details about this market, so keep up with our weekly and daily videos that we post in our channel. Subscribe and tune in. Thank you so much for your time, and have a good night.